Welcome to the Education of a Financial Planner, where we look at the major concepts in financial planning through the lens of two quant investors who are learning the ropes of the planning process and how to help clients achieve their long-term goals. Learn along with us as experienced financial planner Matt Zeigler helps us understand the most important financial planning concepts that impact all of us and how we can apply them to achieve the best outcomes in our financial lives. In each episode, we will work through one major financial planning concept from the ground up and learn how we can apply it in the real world. From retirement to college savings to taxes to estate planning, we will cover a wide range of topics that apply to each of our everyday lives. We hope you will join us in our learning journey.
Justin Carbonneau and Jack Forehand are principals at Validea Capital Management. Matt Zeigler is managing director at Sunpoint Investments. The opinions expressed in this podcast do not necessarily reflect the opinions of Validea Capital or Sunpoint Investments. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Validea Capital or Sunpoint Investments.
Matt, and then there were two.
Just the two of us? Do you want to sing Just the Two of Us?
Oh, there you go. We could sing that. Well, let's save the songs for at least, let's get into it a little bit. I know there's going to be some song references in here. But our other co-host, Jack, is away with his family on a much needed and deserved vacation. And we're going to bring Ben in today, but he's spending some time with his family as well. So it's you and I on this Thursday afternoon in the summer. But this was going to be hopefully a good discussion between the two of us.
I'm excited. I would be wanting to have this conversation with you outside of doing this. So that's always the promise of a good episode. I would want to hear your takes on some of this stuff.
Yeah, nice. You know, we've talked about a lot of different topics on education of a financial planner. I mean, we started with goals-based planning. We got into all the different stages of retirement. We talked about annuities. We've talked about taxes. We've talked about asset allocation and asset location. But, you know, I think when you think about the common denominator or common thread in all of that, it really comes down to the discipline of being able to follow those plans. Because if you don't have the discipline, then everything basically just falls apart. And so that's where we wanted to kind of have this talk today around, let's talk about some of the topics that we've discussed and think about how discipline plays a role in there and try to look at it through the lens of why discipline is important. So, you know, let me ask you, when you hear the word discipline in this context of financial planning, what do you think about?
So when I hear the word discipline, my gut reaction is discipline is decisions plus process. So decisions plural plus a process, meaning we have a North Star that we're aiming for, because we don't have a discipline without having this North Star to guide us. There's I know you said I have to wait on song references, but I kept thinking of that Gangstar song Discipline. So maybe a little edgy for 2023, less edgy for 1999 in some of the subject matter. But it was basically this thing, the just because I want to doesn't mean that I will. And it's this idea that Guru's getting across to us where it's like, just because I want to doesn't mean that I'll do this thing. I have this North Star. So I have this discipline, hence the name of the song, because I can make the choice. I can make the decision right now and pick which path I'm going to go down. So when I hear discipline and when I think about discipline at work, I'm always thinking about helping clients with a discipline. We have a process, and the process means every choice is framed in the perspective of some North Star, so that we're never making a decision exclusively in time. Every decision we're making is over time. Now, you're living in Validea Capital with systematic quantitative investing strategies and stuff like that. So you know this works too. When you hear discipline, what do you think of?
Yeah, so from our process, there's two things that I guess I think of. There's one, the discipline that we have when we build investment strategies. So it's in every step of the way, every way that we build a portfolio, it's discipline and systematic. So the universe definition, how big the portfolio is, the actual investment criteria being used to select the stocks, the stop loss criteria, how to try to avoid value traps, how we implement these strategies tax efficiently, the rebalancing dates. So there's a bunch of decisions, but that are effectively disciplines, like the point you made, that are sort of embedded in the investment process into how we construct portfolios. Now, from a client's perspective, it's obviously very important for them to have discipline, particularly when an investment strategy isn't working. Because what we're going to do is we're going to sit here and follow our process. It's consistent, it's repeatable, but our strategies don't always outperform. And actually, the way that we build these strategies, they're pretty concentrated, so they can have big tracking error. So it's important for us to maintain that discipline, because when a strategy reverts and starts to perform better, we're going to have consistently followed the process that we have. And hopefully by educating investors, they can also maintain their discipline to make it through to the backside for when a strategy actually does start to work. So that's kind of what I think of, when I think of us and discipline, that's how I think of it.
It's kind of cool too, because there's the, so in the Gangstar song, there's also the piece. It's kind of like a low key, it's not a diss to Tupac and Biggie, but he's got the thing about, it's like the wrong North Star idea. It's this idea of preaching death versus breathing life. And I think about that because that's like value investing. We're preaching death. We're talking about these busted up companies that are, cigar butts and 10-cent dollars and all these other things that are out there. But it's really about, no, if you can stick to this, you can get that premium. One decision that you have to stick to over time to have the discipline to reap the results.
So let's go back to sort of one of the very beginning episodes where we talked about goals-based planning or goals-based discipline. So let's relate that to what we're talking about here.
A goal is an outcome of a process, and it's not just an outcome that we're trying to manifest it into our lives, but it's usually an assumption, right? So when you're thinking about a model portfolio that's to yield some result, you have to make assumptions about the future. So goals-based planning is the idea of saying, what is the discipline that gets us the assumed result, the assumed outcome? And that it backs up to what are the decisions in time that are going to lead us towards this goal. And I think the cool part about a goal is it can really help frame what we're doing today in the sense. So like, did you put away money for your kids for college in the 529? Did you you did that, right? Mm-hmm. Okay. I thought we talked about this before. So it's like and now how did you do it? Did you actually send money on like regular intervals, default, like as a deferment? Like,
yeah, okay. I had automatic withdrawal set up. Yep.
So this is a super common one for like saving for retirement, or funding kids' educations, where choice architecture. The goal is we want to send the kids to college. So the decision to make is not a decision every time we look at the savings account. Some people want to pay it like a bill once a month or once a year. But a lot of people will say, I need to get this amount of money into the account to pay for college. So that's our goal. So now we reverse engineer that. What's the smallest decision? I'm going to decide today that every paycheck for the next 18 years is going to take this amount of money out. And so discipline reverts back to which decisions can I stick to that get me along the path for the assumption of what I want and then realize the goal of what I want down the road. And I think like goals-based planning, it's as intuitive as it sounds, but that's what we're trying to do. Structure that discipline.
And by the way, I think anytime you're talking about savings, whether it's for a 529 or retirement, or maybe you're saving for a house, I think like an automatic set deposit or, on a monthly basis is definitely the way to go for most people, because there's always going to be times where it's like, this month things are a little tight. I'm not going to fund, the 529. And then you're sort of next month, maybe, something else comes up. So I think the more you can automate those decisions, which effectively is a disciplined way to save, the better that most people are going to be.
So flip this one investment related side that just weigh in on this. So now when the assumptions are off, so in a goal, we say, I think the investments are going to return this. Now the markets are in a giant drawdown. Did you ever, or have you ever, like when the markets puked in the beginning of COVID or in the financial crisis? Did you ever add extra money? Did you ever do anything like that?
Well, not with those accounts, but I've definitely done some adjustments in the investing accounts and the retirement accounts to try to take advantage of weakness. And for the most part, I've gotten those. I mean, I know it could have gone the other way, but I feel like I've gotten that right, tilting into things that I think, look cheap. It kind of happened with technology at the end of last year for me. I took some positions because I was pretty light on tech, given that we're more of a value and quality type of with our own portfolios. So I said, let me take some and move it into the, in the NASDAQ. And that actually, luckily worked out.
It's super cool when decisions. So again, having the discipline is to say you recognize what the goal, what the assumptions are that get you there. And then when something's gone against you, you can make an overriding decision in some cases, or an add-on decision to say, in support of reaching this goal, even though I'm now further away from the goal because of the drawdown or whatever else, I have a way to think about the steps to get there. And if you have a discipline, then you can make that secondary decision and do stuff like add when the world is trying to end.
We did a couple of episodes on planning for retirement. So we talked about young investors planning for retirement, people in their prime earning years, and then those investors approaching retirement, and then those in their later years in retirement. And we broke those down in separate episodes and talked about those different parts and pieces of life and how people should think about retirement planning and all those different stages. But do you think that discipline evolves through those stages, or does it effectively stay the same?
I definitely think it evolves, and I want to relate it to us taking care of clients, because I know you guys too. We serve 18-year-olds, in some cases younger, and we serve 90-something-year-olds. So the full gamut of ages and stages of life are on display for people that we work with every single day at Sunpoint. And you guys have a pretty broad range of ages that you serve too, right? Like there's
Correct.
Yeah. So are you a fourth turning guy? And I'm not saying like the ridiculousness of maybe the astrology of it, but have you read the book? Are you familiar with the concept?
No, what is it?
Just came out? Oh,
okay.
So the fourth turning. So I like to pitch this book as this is the only book that Al Gore and Steve Bannon both gave to all the members of Congress when they got to Washington. So
okay,
slightly eclectic group that all likes this book. So why? It's also the book where the term millennial came from. So myself as an elder millennial, like it's interesting. Strauss and Howe are the two guys who coined this term like in the 90s before everybody adopted the name and everything. So what's astrological, if you will, about the book, it feels like you're reading star charts, is they're kind of saying like there's 4 generations at a given time. And that's like your grandparents are part of a different generation than your parents are a different part of a generation than you, and a different generation from your kids. Generations have common traits. And they kind of say there's these 4 common traits that go in what they call turnings. So like what one generation kind of passes to the next, to the next, to the next before the cycle repeats. So 4 generations of personality types sort of at a broad cultural level before the cycle repeats. And it's really interesting because you can like reverse engineer it and say in society, this is where the 4th generation was the 4th turning of like the people who went off to fight World War II and then who came home and the first generation that's born out of it. And they have historical examples going all the way back. It's a really cool, what I think of as like a retrofit on history for explaining this. Now, everybody wants to then take that, and this is why Al Gore and Steve Bannon and these people are passing it out. Everyone wants to take that and then predict the future with it. And that's cute, but even, I would say, even Howe, who they just republished a new version, so I'm reading the new version right now, which is why I'm thinking about it. He's like, yeah, there's a lot of ranges for how this could play out. We just think the overall logic rhymes. Long-winded way of me getting to this point. Do disciplines change across ages? Absolutely, and they change across generations as well. And I think one of the most beneficial things to understand as planners and investors is actually how the generation that people belong to, so what's happening in your peer group, actually changes the default disciplines you have and then the disciplines you age with. one of my favorite examples in reading The Fourth Turning for the first time 10 plus years ago, the thing that clicked in my mind was I was talking to a client who at the time was probably in their 50s. So they're thinking about getting ready for retirement, right? And they're complaining about their parent, who's also a client, who is basically like swearing. The logic of the parent did not match the logic of the kid. Is this something you can relate to? Do you ever talk to your parents about any of this stuff?
Well, how about I have a 13-year-old, 14-year-old, so I think so.
So you can see it in both directions.
Right. Oh yeah, yes, exactly.
All right. So what's so crazy, and this was like, I still remember this conversation because I was like, oh crap, that's exactly what The Fourth Turning is all about. I was like, okay, so the grandparent was basically a Depression era kid. And it's like, of course, this person can't ever spend principal. They've been hardwired their whole life to like hide money away and do stuff a certain way. Their version of discipline is you can spend any of the interest, any of the coupon, any of the whatever comes off, but never touch principal. And that comes from their Depression era saving, budgeting, spending mentality. Now, the thing that generation then passes on to their kids is they're going to pass on the idea to their kids that like, hey, you shouldn't spend principal, but the kids are going to grow up feeling like mom and dad were always a little bit penny pinching. And that creates a funny thing because at some point in their lives, if they ever decide to spend principal or if they're trying to get around their guilt, shame, whatever about how they spend money, they have to work through all the things their parents told them to do. And that's really hard. And then when you flash forward to like the kids of the same client from this story, it was like the opposite thing. It's like the kids are like, yeah, I want to go to the super expensive college. Like they were totally detached from money and totally detached from the grandparent generation of never touch the principal. So I think discipline is generationally dependent. I think it's stage of life dependent. And I think you always have to look up and down a generation to better understand like negatively where you're situated in your attitudes towards each decision you make. Does that rhyme with you at all? Does that like jive?
Yeah,
with
no, it
brain
does.
works?
Yeah, and I think too, for firms like yours and ours, I mean, but you're, I think, more involved in their total financial picture. But you may be working with a client for 20 years, maybe even longer. Some of your clients might even be coming up on 20 years. I mean, we have clients that have been with us 10 years, and somebody could be working and then transition into retirement and then have healthcare related, whatever might change in their life. So because of those changes, the discipline is going to, the decisions are going to change. And again, we talked about how that, ties into discipline. I think the Fourth Turning thing is interesting. I would be interested, like one of the things I was thinking of is like, maybe tell me if I'm off here, but like home ownership in this country. So like, obviously the middle class in the 50s and 60s was all about buying a home. And I think it stayed that way, even with my wife and I. I mean, so I was born in 76. We bought our home 15 years ago, actually, interestingly enough. And I think that was a big goal. And that obviously has a lot of implications. And, our kids like our house and we like our house and we like our community. But buying a home now is very hard in this country for a lot of people. I mean, given where rates are, given where home prices are, given where supply is. And so you could see a generation, a small shift in which, maybe buying a home isn't a goal of a lot of people. Maybe renting is what they end up doing. And then it changes that. That has a lot of implications, for the economy, for families, for I think how families develop, probably childbirth rates. If you're in, so you could kind of play that whole thing out. I don't know if that's sort of on topic with that fourth generation thing, but that's what I'm thinking of.
100%, because demographics and things like attitudes towards homeownership, and again, the real world application that doesn't feel like astrology, because I think predicting the future with demographics and with stuff like this does get a little bit of astrological. It's like reading your horoscope. So I'd caution anybody about trying to use that to predict the future as a one-off. Like that's not the variable you should solely focus in on. But I will say like that, because you were what, like probably mid-20s in the financial or in the tech bubble bursting, mid-20s? Yeah.
Yeah, you're saying in the
Yeah.
yeah. So I was I was like 20 whatever. So I was born in 76, so I was like 24.
Yeah. So you're 24, and then you're early 30s when the financial crisis happens, right?
Right. Right. Yep.
And not to make this the Justin divulges personal details show, so edit if needed. When did you guys start having kids? Like, how old were you when you had a family?
So it's 2023. Chloe was born in 09. My daughter was born in 09. So right during the financial, she was born at the bottom. I like to say close. The bottom was March.
She
I believe
bottom
the bottom
ticked?
was, the bottom was March 9th of 2009. She was born in May. So.
Well, there you go. So we're not going to reverse engineer all the math that goes into the making of babies.
Yeah, no.
But what we are going to say is things like financial crises, recessions, historically wars and other things, they actually have huge impacts on fertility rates. Like when we go back and we look at like the post-World War II baby boom and we look at that stuff, it's not a mistake where you see these pockets of fertility rates and comfort and different parts of the generation shift. And that changes home ownership, that changes tax revenues, that changes all that stuff inside of a country. And that part of their analysis in the fourth turning, that's to me why that works. Because it's one of the few logical studies where we look at generational defining events and how those don't just impact the generation who experienced it, but the generations on each side. And that, to me, because we have a multi-generational planning practice, that is huge. It was a real eye-opener in just how to relate to people and how their decisions and disciplines change across families and generations.
I was like, honey, Lehman's failed. Washington Mutual's going under. The Fed's bailing out. We can't have a baby. She's like, we're having a baby.
Because she was like, Buffett said, buy America. Now,
yeah, exactly. I like it. That's right. One of the episodes we did was around the 4% rule, which is this idea that, if you have an investment portfolio and you're invested in a balanced strategy between stocks and bonds, that over a 25 or 30-year period, you should be able to draw 4% off the portfolio and hopefully not run out of money. That's the idea behind the 4% rule. So do you think that rules like the 4% rule are objectively good as disciplines?
I think it goes back to your point when you were talking about adding money to like tech last year and stuff like that. The 4% rule is a really great rule of thumb, so long as you're looking at it as just a rule of thumb. You want this barometer of what you can aim for to cast assumptions around. But we always say we have to look at in the planning process what's going on in your life and in markets. And those are two separate tracks. And so if markets are puking and your account values are down, and this was part of the 4% rule episode, and variable withdrawal strategies and retirements, we did an episode just talking about that. When the markets are puking, you have to decide if you can change your lifestyle income needs or not in those environments. So it's these two layers of that decision making. The 4% rule, great baseline, great for assumptions, great as a back of the envelope test on if your assets are going to sustain. But you have to turn around and then say in real time, how is this going to inform our decisions? Because let's face it, 4% is just a number, and you can tell us better than most. Those numbers, the variables in that equation have changed a lot in the last 10, 20, 30, 40, 50, 60 years in that data set. Things like inflation and bonds and all that. How much has that moved? Any rules like that? Any 4% equivalent rules?
Well, I was, what I've seen work quite well. And it kind of is a little bit of a play off what you were saying is, you have clients that might be taking 4 or 5%, but they have a lot of cash someplace else. So in the event that like you have a year like last year when you had the 60-40 down, maybe the most it's been the last whatever it is, 60 or 70 or 100 years, but stocks and bonds both were down a lot. Pulling money from, almost like cash and letting the portfolio recover. I had clients that actually did do that, and I was very pleased that they did that. And I sort of think that, I continue to remind them it was a good decision because now they're back on their standard schedule withdrawal rate, but the portfolio is probably up. I mean, from the bottom last year, I don't even know. The S&P's up like almost 20% for the year. So you're probably talking however much it is, a lot for stocks, for sure.
Yeah. Yeah.
And, you know, because it's not necessarily like what you said about like, it's might be hard for someone to dial in and out of the expenses. If they can, that's great. But it's sometimes hard for people to flex those. And that's more of, I think, something that needs to be worked on maybe over time. So that's why I like the cash balance if you have that available to you. But the challenge with that is that long-term, that cash is going to be a drag, but it serves a purpose, at least for my clients during times like that.
It goes in both directions. And I think that's the discipline on the life side as well as the market side. It's so important. I'm thinking of, I'll never forget this. I think I told this story in another episode where had clients who were approaching retirement. This was in the post-financial crisis era. So firms were getting consolidated. They were both in the healthcare space. They both thought there was better than nil odds that they were going to be redundant in a corporate merger in their jobs. And they were like, we're the wrong age for this. They were early 60s at the time. They both wanted to get to mid 60s at least, if not later 60s, to be on Medicare. But the idea was, how are we going to survive and deal with this if it happens? And because it was shortly after the financial crisis, the big concern was healthcare. So the terroring thought was these Cobras from like, say, 62 to 65 to war on Medicare is going to be enormous, especially if we're unemployed. And we really don't want to hemorrhage money out of our retirement accounts, out of our tax-deferred accounts to get there. So sock all this money away in cash. Remember how much cash was yielding in 2009, 10, and 11, Justin?
Yeah, oh, yeah, that's true.
Yeah. So it sucked. Talk about a huge drag. So then, again, because it's life and markets, a funny little thing happened to healthcare costs not long after the global financial crisis. Do you remember what small little thing happened to healthcare in that period of time?
Was it Obamacare?
Yeah, the Affordable Care Act.
Right.
So these clients had saved all this money, terrified of Cobra. Okay. They both lose their jobs. Income goes to zero. But the Affordable Care Act was, for all of its flaws, a means-based system. So when income went away, the cost of what would have been their Cobra was now in the exchanges, and the cost of healthcare suddenly went from being this astronomical, terrifying thing that we were always going to run out of money at some point before they hit Medicare age. All of a sudden, their healthcare costs were effectively zero. And so in one of the great pre-Affordable Care Act, we were panicked to save cash and have this massive drag on the portfolio. Post-Affordable Care Act, there was a policy change. They had a huge windfall, and that money ended up lasting way longer, even though it was in cash earning zero, just because a policy change happened that nobody could have seen coming.
Yeah.
And discipline is knowing we need to save for healthcare, but then accepting the reality that the world's not. It's that old joke. If you want God to laugh, show him your plans. It's that.
We had an episode about asset allocation and asset location. I don't know if it was the same episode or different episodes or how we did that, but so the idea asset allocation is, what assets you hold: stocks, bonds, commodities, cash, real estate. And then asset location is, what types of accounts you're holding different vehicles or strategies in, whether it's taxable or retirement. I don't know. Did you ever listen to the pod? I don't know, because we've interviewed Corey Hostein from Newfound at least twice. And he's like such a smart, thoughtful investor and deep in the, into the systematic and quantitative strategies and building some really cool strategies over there. But it must have been a Show Us Your Portfolio episode, because we were talking about his portfolio and he uses some return stacking and some stuff, but we were talking to him when early in his career, when I don't know if he was at Newfound or he had founded it or what he was doing, but he kind of didn't set up a lot of retirement accounts. He was investing a lot in these just taxable accounts and buying these high quality kind of dividend grower type of accounts. And this goes way back 10 years ago. So his cost basis on those is so low that it's almost like he can't move out of those without, a major tax liability. So he was kind of telling us that, for him, he really wishes he had set it up differently, because it would have gave him a lot more flexibility on what he was able to do with the investments. If it was retirement accounts, he may not hold those anymore. He might be holding something totally different. For me, most of my stuff, if not almost all, I think the vast majority of our investable assets is in retirement accounts. So when I talk about a move like, tilting a little bit more into the NASDAQ or making these changes, I can do them tax-free. So I don't know. Are those, to me, that's like the melding of decisions to set up those types of accounts, but then the discipline or the knowledge to do that. What do you think?
The sub decisions, right? So when you guys talk to people and you're setting up a quant strategy, you'll actually have the conversation about, is this qualified money or non-qualified money, right? You help with that process for your investors.
Yeah. And I like to, because we are more active, if it's all else being equal, the retirement assets should be what we should be managing. We certainly manage plenty of taxable money, but if I have a choice, if an investor has $1 million and there's 500 in taxable, 500 in qualified, it's like, let us manage the IRA, because there's not going to be any taxable transactions there.
So first, the awareness of those two things, of just what's taxable and what's tax deferred, because then that changes the type of strategy that you can have, that you can implement because of tax drag. And then how's it stack up over time? So for Corey's situation, and Corey's brilliant, and everybody should listen to his wonderfully named podcast, Flirting with Models, and read his research, because the return tax stacking stuff is so useful in a disciplined framework for building portfolios. But this idea of, like, we see this all the time. Somebody's dad or grandfather or grandmother or whoever is buying like McDonald's in like 1950, and now it's been put into a trust, and it's a compounding machine. So It's grown astronomically over a 50 or a 70-year period. And when we see stuff like that, it's like, okay, you have to go through the math of, how are we thinking about this from an asset allocation perspective? What's the contribution to risk? And then how are we thinking about this from an asset location perspective? Where's the thing held? What's the titling and the structure? Is there any way we're ever going to get a step up in basis? If there's not, what do we do? Do we self-create a dividend? Something Meb Faber's written about this a lot. Do you sell some at long-term capital gains, because that's the same tax treatment still as a dividend rate? Do you come up with a program for that? It's part of the discipline process is to understand it. The other thing, just to tie it back into the fourth turning and the generational piece too, is as your life goes through those different phases, there's also a huge mindset shift that happens between, like we did with all the different phases of saving up for retirement, then getting into retirement, spending stuff down. Not enough can be said about the mindset shift that happens when you have money coming in from a job and you have a surplus on your cash flow and it's building some asset with tax deferral. When you have to turn around and now your cash flow is in a deficit, and now you're spending down an asset, and you're introducing back the taxable liability of diminishing an asset that you've been saving into for a long period of time, that messes with your brain. And you really need people to help you think through this, because back to that original point about how your decisions are going to change over time, your discipline, that idea of a North Star, that's going to shift with your age, with your life, with whatever's happening with you. And that's a big deal, because that active strategy inside of that 401k, all of a sudden when it has to start paying money out because you're retired, you might have some tweaks to make and some extra considerations.
So true story. It was like last week I was on LinkedIn, and Corey had just posted like one of his podcasts, and he has those cool covers. I don't know who he interviewed, and so I was scrolling and I stopped, and my wife walks in, and of course she's like, flirting with models? Like what? And I'm like, no, this is a podcast. I swear to God. It was just funny. I was like, Corey's getting me in trouble.
I hope you told Corey that story.
I'm gonna tell him. I'm gonna send him a link directly to this part of the podcast. So what are your thoughts on sort of Chat GPT and whether or not that could add discipline to the process?
I'm excited in ChatGPT or AI to add discipline in the same way, in a more advanced version of like the administrative component of decision making. And I think about it like the stuff that I have, like the sticky notes that I basically have like on my computer monitor and the note cards and things that I leave around my desk. I like the idea of AI as like a sidecar or something that can help me monitor the decision making in real time to nudge me to remember the North Star of what I'm doing. Because if discipline is going to be that decision plus North Star, I think AI can be promising in its ability to just remind us of what the North Star is within that. The other thing, and it's totally a Phil Tetlock idea, is kind of the dream scenario for stuff like this. If you could have anything you want, magic wand, it's give me the how often is this person right or how often is this idea right thing. So if I'm about to go make that trade on the micro cap stock that I got sucked into the story for, like, where's the thing that reminds me, hey, remember the last 3 times you did this and it was awesome for a few months and then they went bankrupt and you had to figure out the process? Like, whatever thing is that keeps you, if AI can be the thing that stands between me and stupid, bring it on. Do you see ChatGPT or any of this stuff being useful like sooner than later in your processes?
Yeah, I don't know about in terms of the time, like I'm thinking about like how it's integrated into things like Salesforce, or, I mean, it's coming. And, I could certainly see, it probably is already there. If you could set these things, and they're technologies that kind of do this, that can like drip on people and nudge people and remind people and create an opportunity to have more conversations with clients, which I think is always a good thing, keeping the communication lines open. But I think, that what you said is very interesting. Imagine you can use AI to look back on all your sort of cycle through those past decisions to say, was this a good decision? Did you make money on it? Because let's face it, a lot of times the bad decisions people don't really want to remember or talk about. They kind of kick those over to the side and say, oh, well, it's, I didn't buy that stock.
It's that old thing about like bad decisions are always bad luck and good decisions are always attributable to your genius, self-attribution bias stuff, right?
Yeah. So, but yeah, I think there's going to be a lot of interesting developments there, and it'll be interesting to see if, I think we're a long way away from people totally trusting AI to give like financial advice. There might be a time in the future, but it's people are still going to want to talk to humans, and I think we talked about that in the podcast. And
to the degree that it can aid in positively enhancing the decision process in terms of long-term discipline, I'm all for that. Bring the nudges that I can design myself, not the nudges that somebody else is designing for me. If we can design those nudges for ourselves or for people in a way where you can see the benefits of it, give me the ChatGPT that when I open the fridge and go reaching for the ice cream, it's like, really? Do you want to do that tonight, Matt?
By the way, this may play into just thinking about, because I was thinking about the Peter Mladina episode we did, and he had, a lot of different rules and frameworks for both the planning and the investor side when it comes to factors. But, and there's all these different things that you can optimize in someone's plan, and there's sub buckets and sub asset classes and sub portfolios, and that's actually where AI might present an opportunity, I think, in doing some of that kind of stuff. But what do you think about some of Peter's thoughts relating to sort of this discussion?
I love Peter Mladina's work in the way that feel very similarly about like Michael Kitces too. And for financial planning professionals, those are hopefully 2 household names. Certainly Kitces. Mladina, I think, still deserves more attention. They're amazing because you can go so deep into any topic. And if I want to know about single premium immediate annuities, I can go to Kitces' Nerd's Eye View and find some great in-depth things on every single scope and detail of some quirky thing. And if I want help thinking about portfolio construction in different inflation regimes and how to think about valuation multiples against inflation with withdrawal strategies, Peter's got 3 or 6 or 12 papers he can link to on the topic. The highest value thing I think we do as financial advisors when we're wearing this consulting cap, though, is to have conversations with people and pull out which one of those belong in the priority stack. And that's the thing, I'm unconvinced. I haven't seen a situation where AI is the right character. Like AI right now probably shouldn't be your therapist. And it probably shouldn't be your therapist, part because it keeps making stuff up, but also in part because drawing that out that's human conversational stuff. And I'm thinking about a client situation where we had a client married, so second marriage, cross different state lines, a whole bunch of stuff where because it was a second marriage, they're both thinking of their families in a different way. And there was a lot of stuff. There was new estate planning. There was new stuff to protect assets for kids. There was stuff that had to be protected prenup style from prior marriages and prior situations and all the stuff that just is life as you go on in years. And it was a series of conversations to reverse engineer what order we needed to solve problems in. I don't think there's any way to get to the bottom of what order to solve problems in. That's not the very human conversations of figuring out what matters to which people and then going eye doctor style, this one clearer or that one clearer. You know what I mean?
Yeah, totally. Yeah. Yep. No, I think that's a good point.
When you look at like that vast body of work that's Peter Mladina, is there anything like, do you look at that and you're like, I just want this whole thing in a ChatGPT database so I can query it and tell me what to do? Or how would you love to apply it with a magic wand?
I was thinking like more, if you have like the idea of you have these like sub portfolios with different goals and different return characteristics because they're trying to meet certain liabilities. And could you somehow use AI to find, it was more around the investment side of it, not necessarily like the planning side of it. And thinking about, and I don't know if it was a goals-based planning part or where he talked about like the tranches of the portfolio and lining those up to specific goals or liabilities in the future, and then trying to maybe use technology to back into different asset allocations that would meet those goals. That's where my head was going a little bit more, but I don't know. I don't know if that's, and then kind of automating that rebalancing. Imagine if it was just set up so as timeframes changed and as asset class returns changed and as assumptions changed, you might be able to get a little bit more sort of just natural automation happening in there through AI maybe. But again, that is the question of, would an investor even be comfortable with that? I mean, that's not to say that that's foolproof or anything like that. It certainly could make mistakes, and the markets are, very random a lot of times in the short run.
I love the idea of that for scenario analysis. The way you just said it, like so maybe the ChatGPT advisor thing and the Peter Mladina combination is we have a better way for a human to handle the different scenarios that we want to solve for towards that North Star in ordering and prioritizing and then checking. Because I think that's the biggest thing when I talk to other people about this across our industry is we all want that Tony Stark supercomputer assistant, right? We want to be like, I think is this right? And query some really smart people to tell me like what I'm set up for against this. So,
and by the way, what I'm explaining is what these robo-advisors are kind of doing anyway. So there's nothing unique, although they're not using AI to do it. I'm thinking the wealth fronts and the betterments of the world. But. Yeah,
totally. And that's why we see like behavior in sustained tricky periods gets murky fast. Just like with some of the other ones where the incentive structures get messed up. And that's really hard. I think the human conversation that slows people down is still tremendously valuable. And who knows, maybe we find that out maybe we're the last generation to value this. Maybe that's part of the sport turning thing too. Not closed to that reality, which is we'll have to do a separate podcast sometime on, we'll do Fourth Turning and we'll do Neil Postman's stuff.
I like that.
Read like
I like that
Technopoly or any of those books.
Yeah, let's do it. I like it.
Conversation. Okay,
Yep.
That's fun. So I got to kick this back now. Let's bring this home to the reason I wanted to have this conversation with you when I found out it was just the two of us singing the song in my head again was I know you to be a very disciplined person with your athletic background and with the systematic investing stuff. So I'm really curious, you personally, when you're thinking about discipline in your own life and how discipline informs decision making, this feels like it's part of the Justin Carbonneau DNA. Like,
I think
it is.
Track
with that?
Yeah, I think so. I mean, it's, I think in certain parts of my life, for sure. I think fitness is certainly one of them. But this is going to probably sound silly, but when I actually thought about it, and what I'm going to say here is I think it's going to make a lot of sense. So I think when you think about discipline, think about what makes a factor. I mean, is your discipline persistent over a long period of time? Is it pervasive in the sense that, are you doing it in like all aspects of your life? Is it robust? Are you focusing on the right, decisions? Or your actual actions are supporting the discipline? Is it intuitive? I mean, okay, saving for retirement, yes. Saving for your kids' college, yes. I mean, not having too much debt. I mean, yes. I mean, that's so, and, is it implementable? So I think to me, I was like thinking about what makes a factor. I'm like, well, you can really relate that to like discipline. And that's, Matt, that's when I'm taking a playbook out of your thing, like relating it to like a song or something, even though we're factor investors over here.
I think that's poetry. I think you've just demonstrated you are the guru. You are the gangstar of this for tying that together.
Yeah.
Because exactly the same thing that we do when we do the regression analysis and we reverse engineer what makes a factor. That's all it is. That's just, you're just teasing out discipline. I can't do better than that. We got to go out on discipline as a factor.
Well, I've enjoyed this conversation, Matt. We hope you guys have enjoyed it as well. Thank you for listening, and we will see you next time.
Thanks, Justin.
Hi, guys. This is Justin again.
Thanks so much for tuning into this episode.
You can follow Jack on Twitter at @PracticalQuant.
You can follow me on Twitter at JJ Carbonneau, and follow Matt on Twitter at @CultishCreative.
If you found this discussion interesting and valuable, please subscribe in either iTunes or on YouTube, or leave a review or a comment.
Also, if you have any ideas for topics you'd like us to cover in the future, please email us at excessreturnspod@gmail.com. We would like this to be a listener-driven podcast and would appreciate any suggestions. Thank you.